Financial markets operate geometrically. Capital continuously compounds on itself, meaning that the moment you apply actual volatility to a timeline, the concept of a straight, predictable arithmetic average instantly shatters. Yet human intuition fiercely resists this reality. Economists Elder Shafir, Peter Diamond, and Amos Tversky identified a cognitive bias known as money illusion, the tendency for people to evaluate economic transactions in nominal, fixed terms rather than in real, fluctuating terms. Because the brain defaults to linear thinking, we naturally assess the performance of long-term investments by looking at their simple arithmetic averages. If an asset gains 10% one year and loses 10% the next, our intuition tells us the average return is zero. This line graph compares two plots over a 10-year period. One represents a perfectly straight, steady 8% annual growth. The other represents a highly volatile portfolio with extreme peaks and steep valleys. If you simply add up the annual returns and divide by 10, both lines share the exact same 8% arithmetic mean. But because capital is sequentially compounded, meaning each year's percentage gain or loss is calculated on the remaining balance of the previous year, the volatile portfolio's actual terminal wealth falls drastically short of the straight line. Relying on arithmetic intuition guarantees a miscalculation of your actual wealth. To measure compounded historical growth accurately, we must use the geometric mean, often expressed as the compound annual growth rate, or CAGR. This is the constant rate of return required for an investment to grow from its beginning balance to its ending balance over a specific period. The gap between the higher arithmetic average and the lower geometric reality is caused by an invisible mathematical force known as volatility drag, or variance strain. This equation illustrates the relationship. The geometric mean is roughly equal to the arithmetic mean minus half the variance. Notice the top half of that fraction, standard deviation squared. Standard deviation is simply a statistical measure of how dispersed a set of returns is from the average. The squaring of standard deviation in this formula means that incremental increases in volatility apply an exponential penalty to the capital base. Volatility mathematically penalizes actual wealth accumulation. To accurately model long-term portfolio survival, we must abandon simple averages entirely and isolate the impact of this variance. We can see the extreme consequences of this formula by examining the performance of daily leveraged exchange-traded funds, or ETFs. This bar chart displays the 5-year annualized returns for MicroStrategy stock using a data model from Aptus Capital Advisors. The standard unlevered asset shows a massive 87% compound annual growth rate. If you purchase an ETF applying 2x leverage to this asset, logical arithmetic assumes you yield double the return. But the modeled 5-year annualized return for the 2x levered version of that exact same stock falls to 44%, performing worse than the unlevered asset. This discrepancy is the direct result of volatility drag operating in a high-variance environment. Doubling the leverage of an asset doubles both its daily return and its standard deviation. Because standard deviation is squared in our formula, doubling the leverage applies a 4x multiplier to the volatility drag penalty. In highly volatile assets, this quadruple drag aggressively devours the capital base, completely overwhelming the magnified arithmetic returns you gained from the leverage. Leverage amplifies variance decay. Holding non-diversified, highly volatile leveraged assets over the long term inevitably destroys capital compounding. During the accumulation phase, when you are simply holding assets, the chronological order of your annual returns is irrelevant. This is dictated by the commutative property of multiplication, a mathematical rule stating that the order in which you multiply numbers does not change their final product. Whether a massive 30% market crash happens in year 1 of your accumulation phase or year 10, a portfolio with zero capital outflows will always arrive at the exact same terminal wealth. But a critical phase shift occurs the moment an investor retires and begins withdrawing capital to live on. At that exact moment, the commutative property breaks down completely. Regular capital distributions break the commutative property. The portfolio becomes a fragile, path-dependent system where the timing of market fluctuations dictates the survival of the remaining principal. This virginally introduces sequence of returns risk. This is the structural danger where poor market returns occurring early in a distribution phase permanently cripple the portfolio's ability to generate future wealth. This split-screen line graph tracks a scenario developed by Moran Wealth Management. we have two hypothetical 10-year retirement return sequences that share the exact same average arithmetic return. Path A experiences strong growth early and suffers its negative variance at the end of the decade. Path B suffers its negative variance immediately, followed by a strong recovery. Now we apply a fixed 5% annual withdrawal rate to fund retirement expenses across both paths. Look at the mechanics occurring in Path B. The combination of early negative variance and fixed cash distributions creates a forced liquidation event. To meet that strict 5% dollar distribution, the retiree must sell increasingly more shares at severely depressed prices. Despite a massive market recovery in the later years, you can see the Path B balance line plummeting, crossing the $0 threshold and flashing. This is a mathematical lock-in. Because the capital base was permanently fractured by those early liquidations, the subsequent market recovery has no base left to compound upon. Path A, meanwhile, survives the entire decade comfortably. It succeeds simply because the sequence of negative variance was delayed until later in the timeline. Early negative variance combined with fixed distributions permanently destroys the capital base. Once you begin withdrawing money, long-term geometric and arithmetic averages become completely irrelevant to your actual financial survival. To predict and mitigate this sequence of returns risk, financial planners rely on stochastic modeling, specifically Monte Carlo simulations. A Monte Carlo simulation is a computational algorithm that relies on repeated random sampling to calculate the probability of different outcomes. This flowchart maps the architecture of a standard Monte Carlo engine. It requires 4 basic input nodes: initial balance, withdrawal rate, the return assumption, and the standard deviation. The engine uses these inputs to generate thousands of randomized, volatile chronological paths. It stress tests the portfolio's resilience against the worst-case sequences of returns. The final output is a probability of success percentage, representing exactly how many of those simulated paths survived the fixed withdrawals. The critical vulnerability in this system lies in how professionals program the return assumption input node. Planners know that geometric returns are the only accurate reflection of long-term reality. Because of this, they intuitively input a conservative compound annual growth rate into the return field. But applying that professional instinct to a stochastic engine inadvertently introduces a structural flaw into the entire simulation. This is the Kitz's Monte Carlo paradox. Inputting a geometric return into a stochastic model mathematically breaks the simulation. A Monte Carlo simulation's primary function is to organically simulate variance across thousands of chronological iterations. Because the simulation acts out this variance organically, the software natively calculates volatility drag in real time as the simulated markets rise and fall. This creates a mathematical double count. By inputting the compound annual growth rate, which has already had the volatility drag penalty applied to it historically, the planner is penalizing the capital base. Then, the simulation engine immediately applies a second penalty by simulating the variance all over again. As a consequence, the software artificially understates the long-term returns and drastically overstates the portfolio's failure rate. There is a strict methodological correction required here. To model sequence of returns risk accurately, the return input for a Monte Carlo simulation must strictly be the unpenalized simple arithmetic mean. You provide the arithmetic baseline, and the engine itself handles the geometric conversion by organically applying the variance strain across its random sequences. Precision in stochastic modeling requires isolating variance. Relying on intuitive averages blindly obscures structural risks, and in complex software, it mathematically guarantees analytical failure.